Hi everyone, I'm Anuj, and today I'll be sharing the key ideas from the book Beating the Street by Peter Lynch. He's one of the most successful investor ever, and Lynch is known for teaching investing in the simplest way possible. And today my goal is the same, and to explain every concept in a very simple language. So let's start with the big idea, which Lynch repeats throughout the book, which is why stocks matter and why they build wealth better than anything else. So Peter Lynch explains that stocks create far more wealth than bonds or FDs in the long run. And as shown here, 100,000 becomes $25.5 million in the S&P 500, but only $1.6 million in the bonds. Now, this huge difference is because companies grow over time and the stock price follows the same and grows with them. So, but most people still avoid stocks because of fear and not logic. So even in strong markets, people reduce the stock ownership. And Peter Lynch message here is simple. Is that it's that if you want to create meaningful wealth in the long run, you must invest some portion of your money in stocks. So, and to invest in stocks, you don't need a fancy finance degree. Every stock is just a business, and if you understand the business, you can make good returns. So, Lynch even shows how group of seventh grade students beat 99% of the mutual funds just by buying the companies which they actually understood. So now let us move on to the biggest reason why people fail in investing. So it is not because of the market, but because of their own emotions. So Lynch explains that most investors lose money because of fear, and this fear can be induced by scary headlines or inflation or war data or anything else, which makes people panic sell. And investor also get in the short term noise and can forget the long run growth period which the company may actually have. And this all this leads to people buying at high and selling at low price, the exact opposite of what actually works. So Lynch also reminds us that people that the market drops are normal, and even he tried predicting downturns but was proven to be wrong most of the time. So yeah, so finally, let's understand how to think about mutual funds, how to choose mutual funds, and why most people misunderstand how they actually work. So, mutual funds were created to make investing easier for people who don't want to research individual stocks. But today, there are more funds than stocks, so which actually confuses most of the investors. So, Lynch says that most people choose funds emotionally, like picking last year's top performers or a popular brand. But instead, he gives these four clear rules. So, number one would be to know the style of the fund, whether it's a growth fund or a sectoral fund or small cap fund, etc. Number two would be to avoid the style drift, which means a fund should stick to what it actually says. Number three would be to use multiple styles because no strategy wins every year. And finally, number four would be to judge the performance of the fund over a 3 to 5 year period and not just a few months. Yeah, so he also says bond funds usually don't make any sense because fees eats away the returns which you generate in a bond, which is usually small in magnitude. So at the last, you typically end up with little to no returns. And the core message here is simple by Lynch, which is to choose funds logically, understand the strategy, and hold them for the long term. And that's how mutual funds actually help you grow wealth. So from here, I would like to pass to Meet to explain further.
Let's begin with what Peter Lynch teaches about managing a fund. According to him, a good fund manager has three qualities: flexible, empirical, and imaginative. What does that mean in simple words? First, instead of blindly following the market, a manager should rely on data and real experience. Look at the numbers, look at the business, and then make decisions. Second, you must stay flexible. Don't lock yourself into buying only growth stocks or only value stocks or any of that sort. Opportunities show up anywhere. If something is undervalued or undiscovered, you should be free to invest in it, not restricted by labels. Third, avoid playing it safe all the time. Many managers buy only popular stocks which are widely acceptable just to avoid the criticism during their downfalls. But the best returns usually come from the companies that others haven't noticed yet. So you need imagination, which is the ability to see what others haven't till yet. Peter Lynch also says that size doesn't limit performance. Even a large fund can beat the market if the manager is flexible and imaginative enough. And finally, he values patient shareholders of the fund when the market falls because patient investors allow the fund manager to buy more at cheap prices. But if investors panic and exit, the manager is forced to liquidate his positions to service the redemptions and the overall performance suffers. Now, let's look at some investing lessons by Peter Lynch, but this time from the point of view of a fund manager. First, you hold on to your winners and cut the losers. If a company is doing well, let it compound. But if the fundamentals are getting worse, you don't keep averaging it down hoping it will magically recover. Second, your investment logic should be so clear that you can explain it in 90 seconds. If you need 10 minutes, 15 minutes to justify a stock, you probably don't understand it well enough. Third, sometimes the best opportunity is right in front of you, which are the stocks that you already own. If the business outlook improves, adding more to your existing winners can be a smarter move than hunting for new ideas. Fourth, timing matters especially for cyclical stocks. Their ups and downs are very sharp. If you enter late, the rally may be over, and if you wait for too long to exit, the fall can wipe out your entire gains. So, as a fund manager, you follow a simple rule. You stay disciplined, understand what you own, and let the fundamentals guide your actions, not your emotions. Finally, let's talk about a few market signals that Peter Lynch uses to sense when things may be getting risky. One powerful idea he gave is this: when your best case scenario starts looking worse than what other investors think is the worst case scenario, the market is in extreme euphoria. This means that stock prices are so inflated that even the rosiest assumptions don't justify them. It becomes like a ticking time bomb. Another simple signal comes from bonds. Bonds are usually held by very cautious investors. If bond prices suddenly fall heavily, it normally means something is wrong in the system. And if cautious investors are panicking, equity markets, which are far more emotional, could face even bigger trouble. So, Lynch uses this science not to predict crashes, but to stay alert. They remind us that the market always swings between fear and greed, and the best investors know when to stay cautious. Over to Divyansh.
In this, author teaches very simple thing to understand a company. While understanding a company, you should understand both story and the number of business. As the If you are understanding only single thing about it, so you can be misled as an investor. The best company is the one where the both the story and the number react each other. So apart from it, other also explain about the investing is not all about the understanding spreadsheet and analyzing documents, but it happens in the real world by visiting to the stores, talking to the employees, and understanding how the product is manufacturing and sold to the market. So this is all about real investing. And apart from it, authors teach us that we should track limited stock as the quality over quantity, as we will be understanding the few companies very deeply and understanding their cycle to know them when to sell and when to buy them. So moving to the psychology part of an investor, so it explains that the investors in the stock market, news create more panic than actual damages. So here comes an opportunity for the good fundamental strong companies where the news react more badly. So the in the reality the stock falls more than the it's actually happen. So where comes an opportunity for an investor? Apart from it, the investor makes an emotional attachment to the stock after the selling the stock. They regularly check price of and regret their decision. But we should update our about the businesses, not the price of the businesses. As in the long term, the business updates more matter. Apart from it, a great company is an not always a great stock as the if the business is very good but you have purchased it very high valuation, so still it becomes a very bad investment for you. So if you purchase a fast growing company but doesn't make sense if the right valuation is there or not. So let's understand the small things can be convert into big multi-bagger. Like business should have scalable unit economics as an investor. So you should understand the how the cost is there, return should be predictable, operation is simple. So if these things happen multiple times, so it can there can be the compounding can be happen. So business is not all about the how the idea is there. So there should be a greater execution from the management side. So if you are investing in the simple idea, but the execution of the management is good, so it is more better than where the idea is great, but the execution is not is weak. So it's all about the execution.
While others talk about buying what you know or managing emotions, this is where you look under the hood and study what most investors ignore. We are dealing with the unloved sectors, the savings and loan mess, the cyclicals, and the hidden value Wall Street never sees. The edge here comes from using metrics that feel unintuitive but reveal opportunities others avoid. First, the savings and loan crisis. In the 90s, banking stocks were considered untouchables, which is exactly why Peter Lynch looked there. He built a strict checklist to separate the future survivors from the doomed failures. The first number he checked was equity to assets ratio. Anything above 5 or 6 signaled strength, anything under 3 signaled danger. But the nature of those loans mattered even more. The failures were the banks gambling on commercial real estate towers, while the safe ones were local lenders financing houses in their own neighborhoods. If you found a residential lender with high equity trading half below its book value, you were buying a dollar for 50 cents. Then Lynch moves to cyclicals, car, steel, and all the industries tied directly to economic cycle. This is the place where most investors burn money because the logic flips. For cyclicals, price to earnings works in reverse. A low PE is not a bargain, it means earnings are at a peak and ready to collapse. A high PE ratio is often the buy signal because earnings have already bottomed. Lynch did not depend on economists to tell them when the cycle would turn. He watched used car prices. When used cars rise in value, it means people are holding to their vehicles for longer. That creates pent up demand. Eventually, those cars fail and people are forced to buy the new ones, triggering a boom for automakers. It's a cleaner signal than any Wall Street forecast. Lynch then points to hidden assets buried in the footnotes. The pension plan is the first place he checks. An overfunded pension is a hidden asset, an underfunded one is a hidden liability. A company with $1 billion market cap and a 500 million pension surplus is sitting on a value that market usually overlooks. On the opposite end, an underfunded can quietly destroy all the future returns. He then talks about stub value. If a company owns subsidiary worth more than the entire parent company, subtracting the value of the subsidiary can leave you with a remaining business that is effectively free. Those situations are rare, but when they appear, they are powerful. Finally, Lynch explains why earnings alone can mislead you. You have to compare cash to capital spending. Depreciation lowers earnings on paper but does not drain cash in reality. Lynch adds depreciation back to true cash flow. A company look weak on paper but still throw off huge cash. If that cash is enough to pay down debt or buy back shares, that situation becomes what he calls a wonderful buy. The takeaway is simple. Invert the PE ratio for cyclicals, check the equity to assets ratio for banking crisis, study the pension fund, and focus on true cash flow instead of reporting earnings. The best investments hide in the most boring details that people skip. Thank you. Over to Gaurav.
Hi guys, let us understand what Mr. Peter Lynch has to say about utility stock. Utility stocks are generally considered as safe investments, but Mr. Peter Lynch says that the most amount of money which he has made by investing into utility stocks are the troubled ones. These are companies that are facing pressure due to rising raw material costs or have just seen massive asset write-offs which have caused them major impact on their financials. Generally, if a normal business, let us say a car dealership, would have faced similar problems, they would have opted to shut down their businesses. But utility stocks are different. They often operate in services or provide services which are essential for the general public, such as providing electricity, gas, water. So, therefore, if these companies is shut down, then question might be raised on the functionality of a government. Therefore, in order to keep these companies going, the government might allow them to pass on the rising raw material cost or may restructure their debt. Analysts say that these companies go through a major four-stage cycle, which is known as the troubled utility cycle. The first stage is the disaster stage. At this stage, the disaster has just hit the company and the stock of the company is 40 or 50% down. The second stage is the crisis management stage. At this stage, the non-essential spending is cut down and the dividend which earlier the company used to pay is often cut down. The third stage is the financial stabilization stage. At this stage, the company generally generates enough amount of cash to cover its expenses. And the fourth and the final stage is the recovery stage. At this stage, the company is finally able to give dividend to its investors, and the Wall Street or the market generally gains confidence on the company. So, the key learning here is we should buy utility stocks when they are in trouble and hold them till the time the dividend resumes. Now, let us understand a very fascinating concept about privatization. Privatization is the process of transferring state owned assets to the private sector. Historically, such privatizations have been a tremendous opportunity for investors to amass wealth. Why? Because generally, investors who invest in these privatized companies are voters, and in case if these voters lose out wealth, then the vote bank of the government can come under tremendous pressure. Generally, such privatized companies are monopolies and often have huge debt. So, before privatizing these companies, and in order to ensure that the investors benefit from such privatizations, government repay their debt, infuse fresh capital, and improve their infrastructure. Such actions help them to boost their financials. So, privatized companies provide us benefits of a blue chip growth like a small cap and protection of a monopoly. Now, let us understand key learnings from the book. Firstly, Mr. Lin says that oftentimes great investors would question our conviction. However, we must believe in the fundamental of our holdings and have a strong conviction in our holdings. He says that a great fortune is only created when we buy good stocks at fair valuation. For example, when late investor Rakesh Jhunjhunwala bought Titan, the company had a tremendous debt. Its profit had came down from 23 crores to 7 crores and it was just entering the jewelry segment. However, he had a great conviction that the trust of Tatas would disrupt the unorganized jewelry market and would help Titan to boost its profits. So, this conviction helped him to amass a great fortune. Secondly, Mr. Lin says that oftentimes we should look at undervalued companies in booming sectors. For example, in 1992, when the mutual fund industry in the US was booming, Mr. Lynch bought Colonial Group. The group was trading half of the valuation as compared to its competitors. However, it had strong fundamentals. The AUM of the company had doubled and it had a massive cash on its balance sheet, which helped him to create a strong conviction in the company and amass a great fortune. Now, I'll hand over to Daksh to explain you the key economic events.
Hello everyone. Today we will talk about why India's inflation fall to a record low of 12 years. CPI means Consumer Price Index. It tracks the changes in price of everyday goods where 46% weightage is given to vegetable and roughly 7% weightage to fuel. In October, retail inflation dropped sharply to 0.25%. This is the lowest level since 2013 when the current CPI series began. And this matters because it's the third time this year inflation has stayed below the RBI's 4% target. The biggest driver behind this fall was food prices. Vegetables fell by almost 28%, pulses by 16%, and essential like onions, potatoes, and tomatoes become dramatically cheaper, dropping by 54%, 37%, and 43% respectively. The only major category still rising was oils and fats, up 11% due to high global prices. Now, if we remove food and energy, the core inflation stands at 4.4%, slightly higher because GST cuts were offset by rising precious metal prices. The central bank revised its FY26 inflation forecast from 4.2% in February to 2% in December. The unusual low inflation created space for RBI rate cut and RBI announced a rate cut of 25 bps. This will also support liquidity and credit flow, but also put pressure on rupee as it is already on a record low of 90.38. While the economy has shown a strong growth of 8.2% in Q2 and projected GDP outlook has been updated from 7.3% from earlier outlook of 6.8%. The second and territory sectors remain key drivers of the quarterly expansion. Manufacturing grew 9.1% while the construction rose 7.2%. Within services, financial, real estate and professional services registered 10.2% growth, sustaining momentum in the broader territory segment, which expanded 9.2% in Q2 FY26. Also, the GDP new series with base year 2022-23 will be released on February 26, 2026, replacing the current 2011-12 base. Government provided house-like staff workers will now include the value of the housing benefit. Earlier, it was ignored or badly estimated. Unincorporated sectors will be measured better. This includes small shop, street vendors, tiny factories, freelancers, Earlier, the government used very old surveys. Now they will use Annual Productivity Surveys (PLFS), Periodic Labor Force Survey. This gives more realistic numbers because small businesses make a big part of India. Now we are going to talk about PMI index. PMI stands for Purchasing Managers Index. It is an economic indicator that shows the health of the manufacturing and services sectors of an economy. Above 50, the sector is expanding. Below 50, the sector is contracting. India's manufacturing activity eased to a 9-month low, 56.6 in November from 59.2 in October. The HSBC, India's Service Business Activity Index, climbed to 59.8 in November from 58.9 in October. The uptick came after 2 months of moderation. A year ago, the index stood at 58.4. India's Service PMI Business Activity Index rose in November, driven by robust new business intakes that fueled output growth. Overall, India's composite PMI, which combines manufacturing and services, fell to 59.7 in November, the slowest growth since May, from 60.4 in October. Factory production growth was the weakest since May, as firms reported subdued index of new businesses and also shutdowns stemmed partly from heavy rain across some regions of the country and challenges in securing orders due to competitive pricing from rivals in global markets. The data showed new export orders increased at the slowest. The export orders PMI dropped to its slowest points in 13 months. Thank you. Over to Anuj.
The index of industrial production measures short-term changes in a country's industrial output. And India's IIP just slipped to a 14-month low, growing only 0.4% in October. Now, only a few industries held up, which are the basic metals, which grew by 6.6%, the petroleum refining, which grew by 6.2%, and automobile sector, which grew by 5.8%. Most others were flat or negative. Now, the main drag came from weather. Delayed rains hit core sectors hard, like mining fell by 1.8%, and electricity output, which dropped by 6.9%. Now, this matters because IIP acts like an early pulse check for the economy, and weakness in mining and power usually signals broad industrial stress. Now, this is something which markets can't ignore. Now, from here, I would like to pass to Gaurav.
Now, let us quickly understand the data of Index of 8 core industries or the 8 core IIP. This data is published monthly by the Office of Economic Advisors. It measures the production volume growth of the 8 core industries. The 8 core industries are cement, steel, fertilizers, natural gas, crude oil, and refinery products. The data for October month was flat, hitting a 14-month low. This was due to slowdown in the production volumes of coal, electricity, and crude oil. The coal volumes were down by 8.5%, crude oil by 1.2%, and electricity by 7.6%. However, there was a rise in production volumes of cement, steel, and fertilizers. The cement volumes were up by 5.3%, steel by 6.7%, and the fertilizer volumes were up by 7.4%. However, the growth in the industrial sector and the slowdown in the energy sector resulted in the flat growth for the October month. Now, Meet will lead you to the next economic event.
Here's a quick update on India's PLI scheme. The main aim of this scheme is to increase manufacturing in India, but private investment is still getting delayed because approvals are slow and uncertain. To truly boost manufacturing in India, the government needs to speed up the compliance and approval process under PLI. As SOCM Chief Nirmal Kumar Minda has pointed out, land conversion, building permissions, and environmental clearances can still take many months to even 2 to 3 years in several states. On top of this, compliance costs are still high for many small businesses because there are frequent filings, repeated inspections, and GST refund delays. And many businesses have to get 30 to 100 approvals before they can even start their operations, which naturally reduces interest in new investment. Recent articles highlight progress in the PLI auto scheme, with 1,350 crores disbursed to 5 applicants as of 30 November against a total outlay of 25,938 crores and eligible sales at 32,879 crores versus a target of 2.31 lakh crores by March 2028, showing payouts remain low compared to budget and sales target. Over to Jinay.
A new front has opened in the global trade war. Mexico's senators officially approved tariff hikes of up to 50% on imports from India, China, and other Asian economies. Starting next year, these hikes begin to generate $3.76 billion and help fix Mexico's fiscal deficit. By 2026, sectors like auto, steel, textile, and plastics reached the 50% rate, while most others are capped at 35. Autos make up nearly one third of the exports to Mexico, which is India's third largest market after Saudi Arabia and South Africa. The impact is roughly $1 billion for companies like Maruti Suzuki, Volkswagen, Hyundai, and especially for compact cars under 1 liter. Mexico sells 1.5 million vehicles a year and imports two-thirds of them. India holds about 6.7% of those sales, and the slice is now set to become much more expensive. Over to Divyansh.
Let's understand about the recent change happened in India in which 29 old labor law were replaced by the 4 new labor law. This is done to make job more formal and fair for the worker. Now, in this, every employee will be getting an appointment letter, salary on time, proper wages, and the worker who are above 40 will be getting free health checkup from the government. This benefit will be getting to each employee across India, including gig workers, platform workers, and the women will be also allowed to work night shift in a company if they agree with proper consent and the safety. This change may be becoming a problem for the company for the increasing in the cost, like because of the benefits like PF, gratuity, and the overtime bonus. But this will be defining more easily labor law. So this labor law will be aiming to modernize the job market and improve the condition of the workers. Thank you for watching.